Rahima Cassim, who's a research analyst, is in studio to help us through this Rhodes story. Mvunonala Asset Managers. I get a bit better. Mvunonala.
Mvunonala.
But Lala means sleep. Oh, Nala.
No, Nala.
Okay, not Lala.
Mvunonala.
When I hear someone talk EBITDA,
yes,
as Bruce Henderson did just now, it reminds me of Warren Buffett's view on the subject. He says when they talk EBITDA, be careful, because EBITDA is not a line that you should be looking at. You can put all kinds of funnies in there. So that's, I'm already coming with some skepticism on this one. But when you have a look at any new listing, you've got to give them the benefit of the doubt. This is a 100-year-old company, as he was saying. You've looked at it carefully. Do you like it?
I do. I think there's, you look at EBITDA, really it's depreciation that makes it different from your EBIT number.
Yeah, but how much depreciation do you put in? And remember that you've got to replenish that every year in the business. So, anyway.
You do. But one of the reasons why they are listing is really because they need to invest in some of their plants, and they do. A lot of their manufacturing facilities at the moment don't have full capacity utilization. So once they get a lot more volume coming through the business, which would be very positive for them, not only would they get the uptick on the revenue line, but certainly on the EBITDA and the EBIT line, they'd start to get more efficiencies coming through the manufacturing facilities that they have. And
so you clearly disagree with me on this whole EBIT thing. But anyway, the EBIT, those numbers. You say that they need to get more capacity going through their plants. How are they going to do that through listing? Are they taking the 600 million and starting to do more acquisitions, a bit like Ascendus, I guess?
Well, one of the acquisitions they've already made is the Bull Brands acquisition. And one of the reasons why the margin's not looking very robust at the moment is because the Bull Brands margin is only at, call it 2%, which is significantly less than what similar businesses trade at or can generate. So there's a lot of, they pretty much bought a business that was struggling. So a lot of what they can do is turn Bull Brands around and increase that margin. So yes, while they will be seeing margin dilution, and we've got that in our numbers, say in the next year, certainly within this year and going forward, there's a lot of unwind in the margin that they can get just from the Bull Brands acquisition alone.
Bull Brands an old business. Cyril Herbert's goes back a long, long way. How are they going to turn it around if it hasn't been doing that well? What's wrong at Bull Brand?
It seems like Bull Brands was just a business. It came out of GAP. It was just a business that was being not much investment in the business, and certainly not a lot of marketing.
So it comes out of CAP?
Yes.
So Marcus Jooste sold it. And they're going to do better than Marcus Jooste.
Well, at 2% margin. At a 2% margin, Alec, there's a lot that they can do to get that margin. And really, I'm talking the EBIT margin, not the EBITDA margin now. But they can increase that margin over time to between 10 and 15%. And that is where you'll get your earnings unwind coming through over the longer term, which is why we like it, aside from the uptick in earnings that you'll see from paying down the debt.
But why could Marcus Jooste, who's one of our great entrepreneurs in South Africa, as we know, we've seen what he's done, how could he not get Bull Brand right? And these guys who we don't know,
it might not have been a core business for them, so that's why they sold it. And if it's not a core business, and we can see Tigers with Dangote in Nigeria, that wasn't a core business for them, so they didn't invest in that business. This is clearly a brand.
Tiger haven't exactly shone with Dangote in Nigeria either.
Well, Tigers unfortunately have not been able to turn that business around. But look, what you've bought here is a bolt-on acquisition. You've taken a brand, you've brought it into your stable. You can invest in the facilities that you have, and you can take that business, market it, increase the number of SKUs, increase the number of products, and sell into Africa as well. Because one of the things management of Rhodes has noted is that this type of meat product in Africa is a product that is going to be very much sought after. So if they can take that and push it out into Africa through their international channel, it's another form of growth. And that's also why we believe that there's upside in this business.
Okay, lots of ifs, lots of ifs. Bully beef.
Gosh,
No, I'm a skeptic
yeah,
because
I
can see lots of companies have got big ideas and you take it into Africa. You don't just switch on a tap and start selling bully beef into other parts of the continent.
It really is about pushing your actual product through a channel. Whereas if you buy a business the way that Tiger Brands did, that's different because now you have an entire operation that you need to go in and run. Here, as long as you have people who are willing to take your product in and sell it through their door, and you have a supply chain that you can sell through, really you're not taking as much risk as you are in terms of making an acquisition.
All right, if you take a 1 year, 2 year view on this company, which listed this morning, so lots of excitement on first day, what kind of growth are you anticipating from them?
Well, currently if you look at the multiple that they listed at, it looks a bit pricey. But because we believe that there is that unwind in the earnings coming through, and I've done quite a lot of numbers in terms of the sensitivity and scenario analysis in terms of what they could generate, they'd really have to disappoint on the revenue line and the EBIT line to not generate the earnings that we are looking for. And we think they'd probably get to a forward PE of around 14 odd times, which relative to its competitors makes it look more palatable and even cheaper if they can bring the margin expansion that I keep talking about, if they can bring that through so much quicker.
I'll tell you another thing that from the interview that Tumi and David had with Bruce Henderson this morning that bothered me. He talks about repaying expensive debt.
Yes.
Now, if you're a capital allocator, you know the most expensive capital you will ever have is equity. So he's giving away equity to repay debt when interest rates are at near historic lows. I don't know how good a capital allocator this guy is, if that's the way he talks and thinks.
Well, it was a business, it was management buyout, so and there was an element of private equity also wanting to see a return on their investment. So there are many reasons for why the business has wanted to list now. And you talk about, I'm not sure how they initially structured the debt for it to be expensive. In terms of equity being expensive, this is a smaller player, as he noted in the interview, relative to its competitors. If he wants to grow, he needs scale. And in terms of scale, he needs access to capital. And he can only have X amount of debt on his balance sheet. So really what this does is give him access to additional capital so that he can grow his business going forward and get scale in what is arguably quite a competitive environment and quite capex intensive as well.
Well, you've done the research. I haven't. I've just seen the listing today, and I've seen him blowing his horn, and I hope he's going to blow his horn with lots of excitement in the future. Rahima Cassim is with Mvunonala. Sorry, Mvunonala.
Mvunonala.
So Mvunonala, we're in trouble, eh? Mvunonala, we're not in trouble.
We're not sleeping.
What does it mean? What does it mean, Mvunonala?
It means to grow, if you have seeds to grow.
Sure, Zulu is an interesting language.